reporting and disclosure. So under reporting considerations, what are the things that the companies need to keep in mind? Proper reporting ensures transparency and compliance with accounting standards like India's 102. So first is the purpose of the report. Every ESOP report should clearly state its objective. Second is the overview of data used. Description of share-based payment schemes, like different companies have different ESOP structures. Some issue stock options, other issues RSUs, or maybe SAR. So it is important to clearly outline the type of scheme being reported. Then is benefit structure. Benefit structure basically details key aspects such as the vesting schedule, exercise conditions, performance criteria, etc. Then are key variables and assumptions. Again, accurate valuation depends upon selecting appropriate assumptions such as expected volatility, risk-free rate, expected dividend yield, etc. So these assumptions need to be justified based on historical data and industry norms. Valuation methodology, again, as Dribjot explained earlier, companies need to report the models like the Black-Scholes or the Monte Carlo simulation, which they are using to value ESOPs. The choice of model should align with the scheme's characteristics and be consistently applied. Profit and loss and the financial position impact. Then is disclosure on appropriateness of assumptions. So regulators and auditors expect companies to justify their assumptions. Any significant changes from prior periods should be disclosed and explained, as they can materially impact valuation and the expense recognition. Last is movement of options from opening to closing. So companies need to disclose the reconciliation of the number of options starting from the opening balance, additions like new grants, deductions like exercises, cancellations, forfeitures, and the closing balance. This often includes details like weighted average exercise prices to provide further clarity. Accurate and transparent reporting of ESOPs is crucial for both compliance and informed decision making. As auditors and regulators continue to focus on ESOP disclosures, companies need to ensure that their reports comprehensively cover these key aspects. Okay. So in the previous slide, we discussed what makes a report comprehensive. Now let's look at the mandatory disclosures which are required as per India's 102 to ensure compliance and transparency. So under this, first is general disclosure. So every ESOP report must clearly outline the nature and extent of share-based payment arrangements. This include details like vesting requirements, term of the option, settlement method. Then comes movement of share options. So a reconciliation of share option basically is required, tracking the opening balance of outstanding options, new grants during the period, options forfeited, lapsed, or surrendered, and the options exercised by employees. And lastly comes closing balance of outstanding and exercisable options. This is typically presented in a tabular format as can be seen here, along with key metrics like weighted average exercise price and weighted average remaining contractual term. Third point is the fair value of determination. So this section explains how the fair value of ESOPs is calculated, covering like the valuation models used, key assumptions, and the weighted average fair value of the granted options. And last is impact on financials. Finally, companies must disclose the total ESOP expense recognized in the P&L during the period. This expense is a direct cost of employee compensation and it affects profitability. So if we summarize this, these disclosures are non-negotiable under India's 102. They provide stakeholders with a clear view of how ESOPs impact the company's financials and ensures regulatory compliance. All right. So now let's move on to some of the common audit queries that typically come up in ESOP accounting. We get these type of queries a lot from auditors, and rather than diving into the details again, I'll just quickly run through all the questions since we have already covered these aspects in our earlier slides. So first one being assumptions, things like how volatility is determined and how the expected term is estimated. Then the option pricing methodology, which valuation model was used and why. A big one here is expense recognition over the vesting period, whether it is evenly spread or based on some other method. And finally, adjustments for non-standard transactions, like as we discussed, modifications, cancellations, replacements, etc. Okay. So as a part of our webinar campaign, here is a quick snapshot of the detailed audit checklist that we have prepared. This is something that both the auditors and management can refer to at different stages of the valuation activity, such as at the time of data sharing, performing valuation, and report review.
Again, thank you everyone for trusting the team KPAC with your valuable time. Have a good day. Bye-bye. During the session, we have already received one question which says, what is the parameter to set unique business model? Now, I'm presuming this question is pertaining to the volatility that we discussed, the volatility assumptions that we discussed earlier, how the assumptions are set. So when analyzing volatility, we may have to look at the type of the industry. For example, certain industries, example say tech companies or startup companies, have higher volatility because of high growth potential and high risk of failing as well. So, so hence their volatility must be reflected accordingly. While others, for example, utility companies or FMCG companies, have lower volatility because they are generally stable. So hence their volatility assumptions are at a lower end. So we have to, when analyzing the volatility assumption, we have to look at the overall business, overall business, what in what industry they are currently in. I hope this answer your question accurately.